let's just start with some basics. What is crowdfunding? Not just equity crowdfunding, but all crowdfunding. Crowdfunding is really about the ability for a group of people to come together and provide funds for something, where their funds are grouped and able to go and achieve some sort of goal. There are three different types of crowdfunding: donation-based crowdfunding, where the funds are given purely as a donation with no expectation of anything in return. GoFundMe is a great example of a donation-based crowdfunding platform. The next is rewards-based, where individuals are providing the funding in expectation of some sort of item or service being provided in exchange. Kickstarter is a great example of a rewards-based crowdfunding platform. The last example, the one we're here to talk about today, is equity crowdfunding. Equity crowdfunding is all about taking your company and actually allowing a large group of people to give you money in exchange for small pieces of ownership in your business. And so how does that work? How does that actually play out? Because you're offering partial ownership of your company, you can't do that directly with people. You need to work through a platform. So the companies come onto the platform, go through some due diligence, structure their round to raise some capital, either in equity, convertible notes, or some other type of raise. And then the platform helps process that and makes that available to investors, which is a large group of smaller investors who are participating in small amounts, from as little as $100, but can be very large as well. Typically with equity crowdfunding, it's not just people writing small checks. It really is a combination of angel investors writing big checks and your extended community writing those smaller checks. When running an equity crowdfunding campaign, what are you giving to investors? What are investors actually getting? They are getting ownership. When you run an equity crowdfunding campaign and you offer shares for purchase, you are offering partial ownership into your business. As a company, you can choose the type of share, the type of ownership that you want to offer to the public. You can work with a platform to help structure and plan out your round, though rounds are typically run offering non-voting common shares. That is done so that when the investors are coming in, you're getting, potentially hundreds of new investors. These individuals are not suddenly taking over and getting some control of your business. They don't have a say in how your business operates. They're here to support you as the founder, but not try to, get involved in the running of the company. Some companies choose to offer a different type of shares, which might be preferred shares, which might pay dividends to their investors. You can also offer a whole different range of shares, units, sort of everything in between. So it's worth having a conversation with the platform and getting the platform's help to go and structure your round to make sure you're offering what suits your business best. Where does equity crowdfunding really fit in the capital raising life cycle of a company? So on the left-hand side, we have, the company getting started right at the beginning, family and friends, all the way through to eventually having an IPO and going public at the end. Equity crowdfunding really covers a range of stages from pre-seed all the way through to Series A. So equity crowdfunding can help companies raise when they're sort of after they've gotten started. You can't raise on a platform if you're purely at the ideation stage. But once you've developed your business, you have a minimum viable product, you can be pre-revenue, then you're eligible to participate in equity crowdfunding. And through equity crowdfunding, you can raise all the way up to 1.5 million from the general public, or even more from accredited investors as well. So equity crowdfunding and angel investing rounds sort of go hand in hand and often operate at the same time. Typically, you would do equity crowdfunding before you then go out and raise capital from VCs, but it is possible to have, a seed series or a pre-seed series VC actually come in and be the lead investor in your equity crowdfunding round. So there is certainly some precedent of VCs leading equity crowdfunding rounds, but more typically, we'll have the VC rounds come after an equity crowdfunding round. Before we start talking about equity crowdfunding in Canada, let's just give a quick refresh of what equity crowdfunding looks like internationally. It's important to mention that equity crowdfunding rules are segmented based on country, and based on where investors reside. So for example, some of the platforms listed here are licensed and operating in the US or the UK. It would not be possible for a Canadian company to go and raise capital as a Canadian company on these platforms. Basically, it's US company, US platform, US investors, or Canadian company, Canadian platform, Canadian investors. It's important to keep in mind. The reason why we want to look at abroad, the US and the UK, is because the financial regulations are a little bit more advanced in those countries. So we can almost look to the US and the UK to sort of see the future of what will be possible for equity crowdfunding in Canada, where equity crowdfunding was permitted several years earlier in the US and in the UK than it was in Canada. We've really seen massive growth in the equity crowdfunding market in both places. We've started to see platforms acquiring each other as we've sort of entered a little bit of a recessionary period, but certainly billions of dollars being deployed for startups through equity crowdfunding in both the US and the UK. So we've seen that equity crowdfunding has really grown to take a large position in the capital raising life cycle internationally, and it's projected to do the same in Canada. Now let's talk a little bit more about equity crowdfunding in Canada specifically. A bit of background on securities law in Canada. It's not super fun, but it's important to keep in mind. In Canada, securities are regulated by each province who have their own securities regulator. So in the United States, there's a single regulator, the Securities and Exchange Commission. In Canada, there's 13, one for each province and territory. And for a company, whether it's a public company or a private company, anytime you're looking to raise capital, you do need to follow those securities laws outlined by the regulators. Private companies are not, they're still bound by those rules. It's not like they don't apply to you because you're private and then suddenly you're public and now the rules apply. All companies are bound by the rules set by the Ontario Securities Commission. However, there are some easier rules or simpler rules available to private companies to make capital raising a bit easier for them. These are called prospectus exemptions, and you can think of them as legal doorways with which private companies can raise capital. Any company that has already raised capital from friends and family or angel investors has used these rules without even knowing it. And the most popular rule is called the private issuer exemption. This rule is one that you've probably all used, and this allows private companies to raise capital without doing any reporting to the government, as long as they're raising from friends and family or high net worth investors, and as long as they have less than 50 shareholders. So you've all been following the rules, but you didn't even know it. Equity crowdfunding became a new doorway, a new prospectus exemption in 2016 in Canada. However, each province made their own set of rules. None of them agreed on the rules, and it was all a little bit of a hodgepodge. But finally, with some feedback and participation from Equivesto ourselves, in September 2021, all provinces authorized a national set of rules called Prospectus Exemption 45.110 Startup Crowdfunding. And this has been the sort of equity crowdfunding rule that people refer to when they talk about equity crowdfunding in Canada. So let's dive into some of the pieces of that rule and how they apply to you. Before I do that, I just want to highlight a few quick trends about equity crowdfunding and its position. As we noted about the US and the UK, we're really seeing equity crowdfunding growing larger and larger internationally, and in Canada, it's starting to do the same. Initially, equity crowdfunding was seen as sort of a worse alternative to VC funding, but that has really changed, and now equity crowdfunding is seen as an equal and critical part of a traditional capital raise cycle. You've got your friends and family round, then you would have your angel round, potentially alongside an equity crowdfunding round, which in the US is actually referred to as a community round, and then you'd go and raise from VCs afterwards. And by structuring the deal properly, there's no impact on your cap table or in the control of the business. And so that makes it very easy for VCs to still come and participate in your deal afterwards. Let's talk a little bit more about that set of rules that I mentioned, the 45.110 equity crowdfunding rules in Canada. The first piece of information to know as a company is When you go and run an equity crowdfunding round, as I mentioned at the beginning of the presentation, you're not able to do it on your own. You have to work with a platform. And in Canada, under that set of rules, there's two different types of entities that can operate platforms. The first is an exempt funding portal. So this is essentially an online platform that can only use the equity crowdfunding exemption to raise capital. It's not a licensed securities dealer, and it's really a listing location. Platforms like this are limited to only allowing investors to invest $2,500 per campaign at the maximum. So there isn't much flexibility around the amounts people can raise or anything like that, or the amount people can invest when using just an exempt funding portal. The other option is a registered funding portal operated by an exempt market dealer. An exempt market dealer is a fully licensed securities dealer that existed long before equity crowdfunding was a thing and works in the private market to help private companies raise capital from investors. Exempt market dealers use those doorways that I mentioned, prospectus exemptions, to find the right set of door essentially for companies and for investors. With a platform operated by an exempt market dealer, the exempt market dealer can use all of the prospectus exemptions available to help the company raise capital, not just the equity crowdfunding exemption. Part of being a licensed securities dealer requires the platform to complete a full due diligence process called Know Your Product on any company before it lists on the platform, and is required to do a full KYC or Know Your Customer process and suitability assessment on the investors as well before they can sign up to actually make a transaction. The securities dealer, the exempt market dealer, is required to review every investor, their personal financial situation, and help determine if the size of the investment and the type of the investment that they want to make makes sense for them. Because of these responsibilities on an exempt market dealer, they have more flexibility when it comes to who can participate in a round and the amount that they can participate in a round. So whereas an exempt funding portal can only let people in up to 2,500, an EMD run platform can allow the general public to invest up to $10,000 per investment campaign with advice, and can also allow accredited investors or angel investors to invest alongside in much, much larger amounts. The platform operated by an exempt market dealer also has extensive reporting and registration requirements, including annual audited financial statements and all sorts of other information that they have to provide to the regulators. Their role is really to help make the entire transacting process safer, secure, and compliant for everybody involved. Equivesto is a fully licensed exempt market dealer. Let's talk about the types of investors who can participate through equity crowdfunding. On one hand, we have the retail investors, which is essentially the general public. I talked about them on the previous slide and the amounts they're able to invest. On Equivesto, retail investors can invest up to $5,000 per company, and they can invest up to $10,000 if they have a higher net worth and they're sort of proven suitable. We also can bring accredited investors. So accredited investors are high net worth individuals who have over $200,000 in annual income, or $300,000 with a spouse, or over $1 million in net financial assets, excluding real estate. Accredited investors can also participate in equity crowdfunding, and they don't have individual investment limits. Typically, if you're looking to run an equity crowdfunding round raising north of $300,000 or so, you're going to need to get probably about 50% of your raise from accredited investors. They might not be writing, $100,000 checks, but having accredited investors participating, even writing smaller checks, is important to really get the higher raises if you're looking to raise, as I mentioned, over the 300,000. There's something else that I want to talk about that's quite relevant for this presentation. It's not technically part of the equity crowdfunding set of rules. It's a different new set of rules as well, but it fits into the discussion around how companies can let a broader group of people beyond just angel investors participate and invest in their business. In a few provinces across Canada, specifically Ontario, Alberta, and Saskatchewan, there is a new rule called the self-certified investor prospectus exemption. What this rule does is it says, okay, if there are individuals with adequate investment or finance knowledge, even though they don't have the income or the assets to become an accredited investor, because they have the adequate investment knowledge, they are allowed to invest up to $30,000 per year in accredited investor deals or sort of equity crowdfunding deals. So whereas individuals were limited to a maximum of $10,000 before, if they're not accredited, they can now do up to $30,000 per company if they have the proven investment or finance knowledge. There's a whole list of what knowledge is needed and how you prove that. You can look that list up actually on the Equivesto website in our Learning Center under types of investors. But essentially, you need degrees or certifications in business or finance. Think CFA, CPA, MBA, an undergrad in finance, have your Canadian securities course, be a lawyer in the finance space, something like that. Or you can have relevant work experience in the same industry as the company you are investing in. The way you sort of prove yourself as a self-certified investor is you actually have the documentation proving your qualifications. So your degree, your certificate, something like that. The way signing up as a self-certified investor works on the Equivesto platform is you sign up like a retail investor, or we have another category called eligible investor. You sign up as those categories like normal, and then you'd provide your proof to get set up as a self-certified investor as well. In Ontario, this set of rules is actually just a pilot. So whereas in Alberta and Saskatchewan, it's a full set of rules, Ontario is testing it out for the next 18 months. So this is a very exciting opportunity for investors who want to be able to participate, but haven't had the financial setup to be an accredited investor to start being able to participate in those types of deals over the next 18 months. And if the pilot is successful and lots of people participate, they will roll the rules out officially, hopefully in 18 months. Let's talk a bit about who can't participate in an equity crowdfunding round. As I mentioned a little bit earlier, equity crowdfunding rounds are structured based on the rules sort of country to country. They're quite separate. So if you're running an equity crowdfunding round in Canada, you are a Canadian headquartered company and you're raising on a Canadian platform from Canadian investors. Similarly, if you are a US company, you need to raise on a US platform from US investors. There currently isn't really a lot of cross-border investing. There are some ways to do sort of two campaigns at once, but you would need to then do a Canadian campaign for your Canadian investors and then a US campaign on a US platform for US investors to make that work. If you're interested in that, certainly reach out and talk to us. It is a little bit complicated, but it is possible. It just takes a bit more work on that side. Let's talk about the requirements for a company and how the process works from a company perspective to participate in equity crowdfunding. So first, to be able to list on a platform and raise capital, you need to be operating in Canada and you need to be either a corporation or a partnership. You can't be a sole proprietorship. As a company, you can raise up to $1,500,000 every rolling 12 months through equity crowdfunding. You do not need financial statements, but you do need to have a minimum viable product or demo version of your product or service, and you can be pre-revenue. So that's what you need to sort of at least reach out and start the application process. In terms of how do things actually work from a company perspective, when you're raising through equity crowdfunding, campaigns can last up to 90 days. You as a company also need to set a minimum and a maximum raise target. If the minimum target isn't reached by the end of the 90 days, all of the funds are automatically refunded to the investors. At the end of the campaign, if the campaign was successful, you then need to file a one-time report of exempt distribution to the regulators within 30 days of the closing of the campaign. And typically your securities lawyer would help with that. In terms of ongoing requirements, The only ongoing requirement for a company that's raised through equity crowdfunding is the same ongoing requirement that every company has, which is to have an annual shareholders meeting. There's no additional ongoing requirements for startups that raise through equity crowdfunding. Companies that cannot participate using equity crowdfunding are passive investment companies and public companies. But all other types of companies legally can raise capital through equity crowdfunding. But what businesses really work best for equity crowdfunding? Startups work very well for equity crowdfunding. So startups typically have an exciting new idea that captures the imagination of potential investors, and they're creating a strong impact either locally or globally. One example is a startup that's helping make innovative cancer drugs faster, or a new technology that's helping reduce pollution, but is still, a profit-driven business. Another type of business that can work well for equity crowdfunding are small businesses that have a strong community focus and a strong positive impact locally. So restaurants, stores, community centers, breweries, wineries, these all work well as well for equity crowdfunding. Companies that don't work as well for equity crowdfunding are ones where the value of the business is tied to a small number of employees, where if they leave, the company is immediately less valuable. Think a consulting company or a freelance business, something like that. Also, highly technical business-to-business companies can also be a challenge depending on the industry, simply because you need to be able to explain simply and create a captivating story for investors about what your business does. And that can be a bit harder depending on how technical your product is. Now that you understand some of the basics around equity crowdfunding and how it works, what is the documentation you need to prepare as a company to be able to go and apply on an equity crowdfunding platform and raise money? So you need everything listed here: your certificate of incorporation, your capitalization table, organizational chart, a business plan, a pitch deck. Financial statements are helpful, but not required. You also need a shareholders agreement, financial projections, and then you need to know the purpose and the amount of your raise. When working with the platform in anticipation of setting up your campaign, you'll also be preparing the 45-110 offering document, which is a requirement to have before you launch your campaign. The 45-110 offering document is a document required by the regulators for every company using the startup crowdfunding exemption. Essentially, it's a 20-page summary of everything that a prospective investor might want to know about your business, and includes information on the background of the company, details of the founder, terms of the deal, who the equity crowdfunding platform is, the rights of the shares, the risks related to the business and investing, how long the campaign is, use of funds, minimum investment, campaign goals, all kinds of things. The document is also signed off by the company itself, attesting to its truth. So it's important that if there's any changes to the information presented, that the company lets the platform know immediately, and you can create a second copy, an updated copy of the document. This document must also be filed with the regulators as part of that report of exempt distribution within 30 days of the campaign closing. That is a quick rundown of everything you need to know about equity crowdfunding in 2023 in Canada. You can learn more at equivesto.com/learn, and you can also join our community at community.equivesto.com, where we have free training courses for companies and investors on a variety of topics. And thank you very much for listening.